Hello and thanks for tuning in. In this video, I'm going to go over the different types of reverse mortgages available and how they differ from each other in situations where each one is used. I'm Kevin Walton. I've been doing mortgages for over 30 years and specifically the reverse mortgage for over 10 years. The reverse is unlike any other loan and can literally transform someone's life. I offer every type of reverse mortgage that's available and have access to almost a dozen reverse mortgage banks to get the loan done. This is a good thing for you, the consumer, since we don't just deal with one lender and their programs and underwriters. We have options. So as of April of 2022, there are now several types of reverse mortgages available for people over the age of 55 years of age. No longer is the minimum age 62. There are some reverse mortgage programs where the minimum age is 55. There's some where it's age 60 and some that are age 62. So most reverse mortgages do not require any mortgage payment to be made. But there's a new reverse mortgage hybrid loan option where in exchange for partial interest payments for 10 years, a loan can be done for some borrowers whose reverse mortgage applications were denied a reverse mortgage due to a low appraised value. It's a brand new option. So which one is which? It's vital when speaking with a reverse mortgage loan specialist which reverse mortgage loan is being discussed, because there are different guidelines for each one, and you need to know this up front before you start the process. So let's get started. I'm going to give you some very detailed information you'll be able to use here. So the first group of reverse mortgage loans we'll cover is the HECM FHA reverse mortgage. HECM is an acronym for Home Equity Conversion Mortgage and is the one you see advertised on TV. Many people don't know the HECM is in the family of FHA loans. These loans come with upfront MIP insurance, which is like gap insurance. And it's used when at the time the payoff for the reverse mortgage comes into play. If you ever owe more on the balance than the home is worth, the insurance will pay the gap. It makes the lender protected, and you and your heirs do not owe the deficiency to the bank. But this insurance is expensive, but it's necessary to keep the HECM loan program solvent. Every single HECM loan, either fixed rate or adjustable line of credit, must have this insurance. There's no way around it. And the upfront costs associated with this insurance and the monthly premium due can be rolled into the loan balance on a monthly basis. If you ever get a reverse mortgage that is not a HECM, those loans don't have this insurance. In exchange for not having the insurance, the rate is higher. More on that in a few minutes though. Even though the HECM is more cost intensive, it does come with some important protections you need to know that other reverse mortgages may not have. First, if you have a younger spouse under the age of 62 at the time the reverse mortgage application is taken, the younger spouse cannot go on the loan. But if something happens to the older spouse, like they pass away, the younger spouse can stay in the property for the rest of their life with no payments. They just don't get access to any future reverse mortgage proceeds, and they must stay in the property as their owner-occupied residence. They cannot rent it out. Another thing is the payment of property taxes. We take a look at the last few years of the history and how they've paid it. If the borrower is habitually late or shows an unwillingness on paying property taxes on time, an algorithm based on their life expectancy is done, and that number of years of property taxes may be included into the loan amount. That could be 10 or 15 years worth of property taxes at times. This practice has slowed the lender foreclosures in reverse mortgages due to the non-payment of property taxes. This is only available on loans that are newer than the last 8 years. Prior to loans done 8 years ago, this was not done. So new loans going forward have this type of protection done. But again, not all reverse mortgages have this policy. You need to make sure you cover those 2 points when speaking with a reverse mortgage lender before moving forward. Also, there are some unique characteristics to HECM loans. The HECM line of credit can stay open for the rest of your life. That's not true of other reverse mortgages that are non-HECMs. They freeze them, typically after a 7 or a 10-year period. Like a bank HELOC, that gets frozen after 10 years. You can only use it for 10 years. The HECM line of credit stays open the rest of your life. It's a nice feature. The HECM line of credit, unused portion of the line of credit, what you haven't used yet, goes up every single month for the life of the loan. The rate at which it accumulates is the rate attached to your loan that determines the growth of the available line of credit. Again, another unique feature to this loan. The HECM line of credit cannot be frozen due to home values dropping. Other reverse mortgages that are not HECMs can be closed at any time without notice when your home drops in value. Not so again with the HECM. For condominiums, if the complex is not FHA approved, a HECM cannot be done in that condominium complex. HECMs have the lowest rates, but also the highest closing costs, again due to that MIP insurance, and I'll go over that in a minute. HECMs have moderate loan amounts, and there is no jumbo loan option available on the HECM. So let's take a look at a couple HECM examples. I'm going to go over these pretty quickly here, just for the sake of keeping this video short. Here is a reverse mortgage line of credit. We have an $800,000 home value with a 71-year-old borrower. As of today, that rate's around 4.295. We're paying off a mortgage balance of $125,000. Closing costs, you see at $26,000. The largest lion's share of that is the upfront mortgage insurance premium. It's 2% of the property value. So 2% here would be $16,000. Now this seems expensive, and it is expensive, but for what you get on this loan, over the life of the loan, it's like an insurance policy of sorts, and you'll see why in a minute. So we have a starting loan balance here of $151,000. You have a line of credit left of $243,000. Now let's take a look at a 5-year snapshot of this loan. After 5 years, the loan balance has gone from $152,000 to $217,896. And that's if you don't make any payments. Now what I did here, I increased the rate by 1% because this is an adjustable. And to be honest, we are in a rising rate environment. We can't pretend that we are not. So rates, I increased the rate by 1% first year, and then an additional 2% the following year. Now I don't think we're going to go up 3% in 2 years, but I want to give you a worst case scenario so you're prepared. So your balance goes up from $152,000 to $217,000, but your line of credit has grown to $351,000 for you to use. It's gone up almost $100,000 in 5 years. In 10 years, it's going to go up even more, much more. So that's a nice feature to have. Access to more credit if you ever need it and you don't have to do a thing to get it. That's the line of credit. There is a HECM fixed rate as well, and the fixed rate, a little lower loan amount of $366, closing costs the same, your rate's 5.68, and you've got a balance of $236,000 after 5 years. Now if you make monthly payments, that obviously will make that go down. Also on the line of credit, if you make monthly payments, every payment you make, that same dollar amount is redrawable later in the future. That's additional credit line growth you're going to get. So that's the HECM reverse mortgage. Now I can make a video specifically unique for your situation that show these numbers, but for time value, we're going to carry on here and move on to the next group of loans. But before we do that, when do you use a HECM? So HECM, you could use it for additional cash flow because there's no monthly payments required to pay the loan back. Again, if you don't want to make them, but you can make payments if you want to. You can use the line of credit feature, which I just showed, to pay for in-home health care. And you don't want to wait to get these loans done until it's too late. In other words, you want to make sure that the borrower or your loved one has their faculties about them to get the loan. It's very hard to get these loans done when someone doesn't have their faculties. So you want to get these things set up and ready to use for a rainy day. Also, the HECM line of credit is a bucket of money not in the market that you can dip into to live on during hard market times. If you're living on your nest egg, you don't want to take an advance from that nest egg while the value of it's going down. You need to have access to funds somewhere else to dip into to give your portfolio time to recover. You can use the reverse mortgage to buy a home. Nobody knows about this. I have another video on that as well on my channel. But basically it's 50% down payment, no payments in the balance. Again, check out the video. The bucket of money not in the market, we have a study that shows a portfolio, how to use the line of credit in conjunction with a withdrawal strategy in retirement to make sure you don't outlive your money. There's a video on that on my channel as well. Silver divorce. I have a video on my channel on how to use the reverse for that. Estate planning to pay IRS and franchise tax board funds owed. Also for Medicaid for people looking to get into a facility, there's a spend down that you have to do there. The reverse mortgage can come into play there. Home improvements, business expenses, the possibilities literally are endless for the HECM. So let's look at a non-HECM. These loans allow for younger minimum age requirements down to 55 years of age, and they do not have that FHA MIP expense. But does that make them better? It just depends on the situation. No FHA HECM MIP insurance, so it's less expensive in costs to originate the loan. A lower age is allowed, so what's the catch? Basically, lower loan amounts at times. They're a little more conservative, but also they do loans over $4 million. It's a jumbo reverse mortgage. The HECM can't do that. They can even do exceptions on these loans. I've seen up to $15 million in certain situations depending on the property value. This can take care of a multitude of problems that the HECM cannot fix. A few important differences on the jumbo non-HECM reverse mortgages. Again, younger spouses than 55 cannot go on the loan. Also, younger spouses than 55 are required to make a video with an attorney present, acknowledging they realize they are not going on title and they do not get access to funds. Also in that same video, the spouse is going to have to acknowledge that they have to pay the loan off or sell the home once their older spouse passes away. They do not get to stay there. Big difference between the HECM and this loan. Some jumbo lenders may not give you the option to collect property taxes, as on the HECM, as I mentioned, and include them into the loan, which for some can put them at risk if they need time paying property taxes. You don't want to go delinquent on your property taxes, folks. The county can foreclose, and when they do, they don't give the lender any money. They lose their balance. That happens with any loan, by the way, not just reverse mortgages. So you definitely want to keep an eye on your loved one if they have a reverse to make sure those taxes get paid, unless it's rolled into the loan, as it can be by the HECM. When it comes time to sell the home or refinance a mortgage, jumbo lenders may not give as much time for you to pay off the loan as a HECM. With a HECM, they can give you time and extensions every 90 days to help dispose of the loan or the property. Not so much with the non-HECMs. they're much more aggressive. They don't have to give you the extensions. So just know that you don't, if you're thinking of fixing up the property before listing it with this type of loan, not a good idea. You're not going to have enough time to get your project done. The HECM, possibly, but that's something you don't necessarily want to tell the lender you're going to do, because otherwise they may end up with the property thinking that they have a project that's half done and they got to pump money into it, a project you didn't finish because you ran out of money maybe. That's what lenders think, the worst case scenario. So you got to be careful what you tell the lender. But again, with a non-HECM remodeling prior to selling, probably not going to have enough time to do that. The line of credit feature on the non-HECM gets frozen after 10 years. The line of credit feature available growth rate stops after 7 years. And it grows at 1.5% on a fixed basis, the available line of credit. So it grows a lot slower than the HECM and for a much shorter period of time. Non-FHA approved condominiums over $500,000 in value are eligible on the non-HECM. It's a nice problem solver. So let's take a look at a couple of non-HECM loans, just like we did on the HECMs. So the first one we'll look at is a line of credit reverse mortgage non-HECM loan. Same situation, same value, $800,000, same age. You see here a rate, much higher rate, close to 7%. Or 6.8%. That's what it is as of today, and these have been going up as of April 2022 at a pretty quick clip. There's a monthly service fee of $20. Now see your closing costs? They're not $26,000, they're about $7,000. This is high also. The $26,000 on the HECM I quoted is high as well. We need to quote high to make sure we're not short, because basically if we're short, I have to pay for the difference out of my pocket. Not something I like doing. So I make sure that I quote high enough to cover costs, and if we're too high at the end, we reduce it. But again, you don't see that $18,000 figure for MIP insurance in this loan. And you get a little higher loan amount here too. Almost $421,000. So that is the summary for a line of credit non-HECM. Now if we take a look at what this loan looks like after 5 years, you have a loan balance of $222,975. Again, I have the rate going up here, 1% the first year, 2% the second year. There are caps on this loan. It can go up 10% of its original rate. The HECM can only go up 5%. So it has a lower cap. And it has an annual cap, the HECM does, 2% a year. This doesn't have an annual cap. The line of credit you see at the end of 5 years is $315,000, so it hasn't really grown very much, not anywhere compared to the HECM. Again, for your situation, for you personally, I can make a video for you specifically for your situation, but I just wanted to let you see some of these numbers. Then also we've got the non-HECM fixed rate. So we have a fixed rate here, 6.375, same thing, same value of home, same age, loan amount $387. It's a little higher than HECM by about $20,000 or so. Fees are a lot lower than the HECM. And if we look over a 5-year period, $215,000 for the loan balance, so it's a little bit lower than the adjustable, but it does have a fixed rate. Alright, now we'll jump back into the presentation. Now when do you use a non-HECM? So the non-HECM, if you have a condo not FHA approved, the complex not being approved, you can't do a HECM in there. This would have to be the non-HECM. You'd have to talk to your HOA association as to why they're not FHA approved. They just don't want to do the homework and pay the fee to do it, is basically what it comes down to. But just know you have a reverse mortgage that can fit that situation. If you need a much larger loan amount than what the HECM can provide, the non-HECM is the solution there. If you're not able to qualify for a conventional home loan refinance due to a lack of documentable income, any reverse mortgage really is applicable. And we're running into that a lot during COVID, by the way. People's incomes have just been hit so hard. If you're between the age of 55 and 62 and are in need of a reverse mortgage loan and can't wait for the HECM age limit, this will work also. Also, if you need a short-term loan, over the lifetime of the loan, the HECM, even though it's more cost-intensive, is the better option when it comes to expense, interest expense, because it has such a lower rate. But if you're going to stay in the property for, say, 3 years or so, the non-HECM might be something to look at. It has less in closing costs up front, as long as you don't stay there too long. And I could do an analysis for you to show you these numbers, 3 years, 5 years, 10, 15, 20 years to compare, so you can see where the numbers are. You'll see the HECM, the longer you keep the loan, it is actually the better loan to have. And going over the numbers, the interest expense for a HECM over 5 years, due to the lower rates, is almost $20,000 less than the non-HECM. Over a 10-year period, it's almost $70,000 less. $70,000 less in interest expense. Again, it's more expensive to originate it, but over time, it can save you quite a bit. The available line of credit has grown $55,000 more over 10 years than the non-HECM line of credit, which gets frozen at 10 years and stops growing after 7 years. And then the non-HECM cost is $26,000 more in loan amount. That's worth mentioning. You get a slightly higher loan amount with the non-HECM. But again, the expenses over time can really run up on that non-HECM. So when do we use a non-HECM? I'm sorry, I went over the slide already. So the hybrid reverse mortgage option. This is a newcomer to the reverse mortgage family of loans. Very unique loan. A hybrid reverse is a loan option where partial interest payments are required for the first 10 years of the loan, and then no more payments are made for the rest of the life of that loan. This loan option is only available if you've been denied a HECM reverse mortgage or a non-HECM jumbo mortgage due to a low appraisal, and it's possible the borrower could qualify for cash out on this loan as well. Again, at this moment, this loan is only available if the HECM loan or non-HECM loan is declined due to a low value. I can see guidelines changing on this loan as we go forward, and it may be more flexible in the future. But as of now, that's what the rule is. The minimum age for the hybrid reverse mortgage is 60, so it's a little different than the others. 62 on the HECM, 55 on the non-HECM. All the other non-HECM jumbo loan characteristics that I went over in the other slides are the same for this loan. So let's take a quick look at this loan. Okay, we have a loan, same thing. The house, $800,000, 71 years old, but it didn't appraise for what we needed for the HECM. We're able to get this customer a loan of $500,800. We're paying off a mortgage balance of $450. Closing costs about the same as the other non-HECM loan. And here, the cash to close, they actually get $44,000. I did one of these for a customer where they got turned down for a loan. They were going to have to move out of their home. And instead, we got them a loan and we paid off a huge chunk of credit card debt and gave them a life raft, basically. Monthly payment here fixed is $1123.57. On a loan amount of $450, or actually even $500,800, it would easily be triple that. And it's good for 10 years. wrap things up, when would you use a hybrid mortgage? Well, if you can't afford your mortgage anymore, this could help. If your need cash out loan have been denied a HECM or non-HECM mortgage, this can help. This loan during COVID has become, as I mentioned, a life raft to people who experience income loss due to COVID, changing the landscape of their profession and business, and they just can't quite qualify for that conventional mortgage financing. Now, this loan is underwritten just like a regular forward mortgage loan. You have to have enough income to qualify for this one. The other loans, the non-HECM and the HECM, much friendlier income documentation guidelines versus the hybrid. So the other thing to mention as well, not only one lender offers this loan option, and I have it. So again, it's not something everybody has. A lot of banks have, and you may not have heard of it, and that's why. So being a loan broker situation like I am, I have access to this loan. Here's some common reverse mortgage guidelines for all reverse mortgages. Property's got to be owner occupied, have to live there at least 6 months and 1 day per year. Can't do any VRBO on these loans. The loan is not transferable to other people who are not on the loan. Once the last person passes away, the kids or anybody else cannot move in until that loan is paid off. The loan must be paid off or refinanced once the last person on the loan passes away or is no longer living in the property as their owner-occupied residence. Any equity left over after selling the home goes to the heirs, not to the bank. Also, all these loans have counseling. So they have to go through this counseling before we can go forward with a loan application to make sure they understand what they're doing and they understand how it works. Each loan has its own unique counseling. So if you get a HECM and you decide to flip to a non-HECM, you would have to get 2 versions of counseling because they each are a little bit different. Counseling costs about $150 and it's paid for up front by the borrower. So I've got other videos on my YouTube channel that are dedicated to the hybrid reverse, the HECM Atlantic credit growth rate, reverse mortgage fees, how that works, the differences between HECM and HELOC, silver divorce, how to use it in reverse. I have dedicated videos for that on my channel. Feel free to go to my channel and watch them. So, and please click the subscribe button on the bottom right to get alerted to any new videos I make on the reverse. New reverse mortgage products are being introduced and guidelines are changing all the time. And I will make new videos to reflect these changes as they become available. Thanks for taking time out of your day to watch this video. Feel free to call me on the number there, or you can text me or email me your scenario, and I'll be glad to make a video for you to go over your unique situation. Thanks again. Take care.